A notice appeared on the CFTC website. Most people missed it. It went up after the close tucked away in the regulatory announcements section. But the headline should have stopped the world. An emergency commission meeting scheduled for December 19th in 2025 at 9 o'clock a.m. closed session. The topic listed market stabilization measures for the precious metals complex. That's government speak, for we're about to change the rules to protect the banks. I've followed the silver market for years. I've watched manipulation, suppression, and every trick in the book, but I've only seen this specific move once before. In 1980, when the Hunt brothers tried to corner silver, regulators responded with liquidation-only trading. That made it illegal to open new long positions. You could only sell, you couldn't buy. That rule crushed the Hunt brothers. It drove silver from $50 down to $10. And now, 45 years later, they're preparing to run the same play again. That CFTC meeting on Monday morning isn't a conversation, it's a verdict. The decision is already made. By Monday afternoon, you may not even be able to buy silver on the COMEX. By Tuesday, that restriction could spread to ETFs. By Wednesday, it could reach physical dealers. You have 72 hours. In this video, I'm going to show you what's likely coming. I'll walk you through the 1,980 playbook they're following step by step. I'll explain why this emergency meeting is a sign we're winning, not losing. And I'll tell you exactly what to do in the next 72 hours before they shut the door. This is not a drill, this is the empire striking back, and you need to be ready. Let me show you the exact notice because the wording matters. The CFTC announcement posted December 16th at 5:30 p.m. reads as follows. The Commodity Futures Trading Commission will convene an emergency meeting on Thursday, December 19th, 2025 at 9:00 a.m. Eastern Time to address urgent matters related to market integrity in the precious metals futures complex. Disclaimer, I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned in this video. This is purely educational analysis based on publicly available information. Now let me take you back to 1,980, because this isn't theoretical. We've watched this movie before. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, were billionaire oil tycoons from Texas. In the late 1,970s, they became convinced inflation would destroy the dollar, so they decided to buy silver, lots of it. By 1979, the Hunt brothers and their associates had accumulated roughly 200 million ounces of physical silver. They also held enormous long positions in silver futures. At the peak, they controlled about 1/3 of the world's deliverable silver supply. As they kept buying, the price climbed. Silver jumped from $6 in 1979 to $50 by January 1980. The Hunts were making billions, but the banks on the short side were bleeding billions. J.P. Morgan, Engelhard, Makata Metals, everyone was short. They were staring at insolvency. So they called their friends in Washington. On January 7th, 1,980, the COMEX Board of Governors held an emergency meeting. The next day, new rules dropped. They called it Silver Rule 7. It put the market into liquidation-only trading effective immediately. Traders could only close existing positions. They could not open new long positions. You could sell, you could not buy. The impact was instant and brutal. If you're long silver and you can't buy to roll your position forward, while everyone else is only allowed to sell, the price has one direction to go down. Silver collapsed from $50 in mid-January to $10 by March, an 80% crash in 6 weeks. The Hunt brothers lost over $1 billion. They declared bankruptcy. And the banks, they made it through. The CFTC and COMEX justified the move by claiming the Hunts were manipulating the market. They said it created an artificial shortage and drove disorderly conditions. But here's the truth. The Hunts were buying a real commodity in a market where banks had sold more paper silver than the system could deliver. The Hunts demanded delivery. The banks couldn't deliver. So the rules got changed to rescue the banks. That isn't a free market, that's a rigged market. And they're setting up to do it again. Let me show you the parallel because it's almost a carbon copy. 1,980. The Hunt brothers accumulated 200 million ounces. 2,025 open interest in silver options and futures represents roughly 700 million ounces. 1,000. 980 banks were net short and facing delivery pressure. 2,025 commercial banks are net short, 250 million ounces, and heading into options expiration on Friday. 1,980. A physical shortage was forming. 2,025. COMEX inventory sits at 92 million ounces. Refineries halted. Physical premiums at $12. 1,980 price, spiking to $50. 2,025 price at $62 and rising. 1,980 emergency intervention liquidation only rule. 2025, an emergency meeting on the calendar. with temporary trading restrictions on the table. It's the same playbook. The dates are different, the players are different, but the mechanics are the same. The banks are trapped. The government steps in, and retail gets crushed unless you see what's coming and prepare. Here's what I think they're going to announce Thursday morning. Let me lay out the likely measures. Measure 1, liquidation-only mode for large speculators. The CFTC announces that any non-commercial trader above a certain threshold will be barred from increasing their position. They can only reduce. They can sell or let contracts expire. They cannot buy more. That forces big longs to unwind. Measure 2, margin requirements pushed to 100%. Right now, holding a silver futures contract takes about $10 0 inches margin per contract. They could raise it to $50 000 or even require the full notional value. This makes it impossible for leverage traders to keep positions open. They'll get hit with margin calls and be forced to sell. Measure 3, position limits cut to 500 contracts per entity. Right now, the position limit is 6,000 contracts for silver. Now let's talk about the legal basis, because this part matters. How can the CFTC just ban buying? Doesn't that violate free markets? Technically, yes. But the Commodity Exchange Act gives the CFTC broad emergency authority under Section 8A9. It says the Commission may take emergency action if it determines an emergency exists that threatens the orderly functioning of commodity trading. And the law doesn't tightly define what qualifies as an emergency. It's largely discretionary. If the CFTC declares an emergency, they can impose temporary trading restrictions without congressional approval, without public comment periods, and without due process. Those restrictions can last up to 120 days and can be extended. This is the legal hammer they used in 1980. This is the hammer they'll use now. And once they declare an emergency, courts usually defer to the agency's judgment. You can sue, but you'll lose. The Hunt brothers sued in 1980. They lost. The precedent is already there. When the government wants to rig the market to protect the banks, they can and they will. Here's what happens next, hour by hour after the announcement. Thursday, December 19th, 9:02 a.m. The CFTC meeting begins. Closed session. No media, no public. By 10:30 a.m., the meeting ends. The CFTC chairman issues a press release in response to extreme volatility and disorderly trading conditions in silver futures. The Commission has approved emergency measures. Effective, immediately position limits are reduced. Margin requirements are increased. Large speculators are restricted from increasing long positions. These temporary measures are necessary to protect market integrity and retail investors. 11 a.m. CNBC breaks the news. Talking heads say regulators are stepping in to cool silver mania. They frame it as responsible oversight. 11:30 a.m. Silver futures gap down from $64 to $58 in minutes. Why? Because large funds are forced to sell. They can't hold positions at 100% margin. They liquidate. 12 p.m. Retail panic. Silver investors see the price collapsing and think it's over. They think the government killed it. They dump their positions. ETFs calls everything. Capitulation. 2 p.m. By the end of the day, silver closes at $50, down $12 or 19% in a single session. Options expiring Friday are now out of the money. The $70 calls are worthless. JP Morgan and the banks just got bailed out by the government. The gamma squeeze is dead, or so they think. Here's what they're not accounting for. The physical market doesn't care about CFTC rules. Let me explain the great decoupling that's about to happen. The CFTC can control the COMEX futures market. They can restrict buying in futures, raise margins, and force liquidation. But the COMEX is only one market. It's not the only market. Silver trades in London through the LBMA. Silver trades in Shanghai on the Shanghai Gold Exchange. It trades over the counter between private parties. And it trades in physical form at coin shops and bullion dealers. The CFTC has zero jurisdiction over those venues. So when they announce liquidation-only mode on the COMEX, what happens? The COMEX price crashes because only selling is allowed. But the price in London, in Shanghai, and in the physical market doesn't crash because in those markets you can still buy. In fact, demand increases. Industrial users who actually need silver can't rely on the COMEX anymore. So they shift to London, they shift to Shanghai, and they source physical from dealers. That buying pressure outside the COMEX pushes prices higher. So you get a divergence. COMEX silver trading at 52. London silver trading at 66. Shanghai silver trading at 72. Physical silver dealers charging $80. 4 different prices for the same commodity. That's backwardation showing up in the physical market. It's the market screaming that the paper price is artificial. And here's the kicker. Once the great decoupling starts, the COMEX becomes irrelevant. Miners won't sell to the COMEX at $50 when they can sell to Shanghai at $72. They stop delivering to the COMEX. COMEX inventory bleeds towards zero. The exchange turns into a zombie market, paper contracts trading like ghosts disconnected from physical reality. That's the endgame. The CFTC thinks they're saving the system. They're actually breaking it. Now let me tell you what you need to do in the next 72 hours, because this is your last window before the rules change. Action 1: if you hold silver futures on the COMEX, you have 3 choices. Choice A: close your position now. Take profit if you're in the green, and get out before the restrictions hit. You can always re-enter later via physical or foreign markets. Choice B: stand for delivery. If you're holding December contracts demand physical delivery, don't let them force you into cash settlement. Make them deliver the metal, but understand the risk. With rule changes, they could suspend EFPs. That can trap you. Choice C: roll your exposure to LBMA or Shanghai if you have access. Get out of COMEX jurisdiction entirely. Move to markets the CFTC can't touch. Action 2: if you hold SLV or other silver ETFs, treat this as your warning. When the CFTC announces restrictions, ETFs could halt redemptions or suspend trading. We're already seeing stress in SLV. The rule changes could become the excuse to freeze the fund. If you're in SLV, you either exit now or accept the risk of being trapped. Your choice. Action 3: if you have cash and you're planning to buy silver, do it this weekend, Saturday, Sunday, Monday morning before the meeting. You go to your local coin shop. You go online to APMX, SD, Bullion, JM Bullion. You buy whatever you can, because by Thursday afternoon, one of 2 things happens. Either dealers get swamped by panic buying and they run out of inventory, or they raise premiums in advance. They could go $20, $30, $40 over spot because they can see the storm coming. Either way, this weekend is your last shot at normal premiums. Action 4: if you already own physical silver and you're thinking about selling, don't. Because what's about to happen is going to validate everything you believed. Government intervention is the tell. They change the rules when the shortage is real. Because the banks are trapped. Because the system is cracking. You don't dump a winning position right before the other side admits defeat. Now let me show you 3 ways this could play out over the next 2 weeks. Scenario 1: the crash and recovery. Thursday, the CFTC announces restrictions. COMEX silver drops hard to $52. Retail panics. The media declares the silver bubble is over, but within 48 hours, physical buyers step in. Industrial users realize they can't actually get silver at $52 because that's just the paper price. They bid physical up to $68. Shanghai opens Monday at $74. By January 2nd, the decoupling is undeniable. COMEX at $50, physical at $85. Miners stop delivering to COMEX. COMEX fades into irrelevance. This is the most likely path: pain first, then vindication. Scenario 2: the global spillover. The CFTC announces restrictions Thursday. Other countries read it as U.S. financial warfare. China responds by banning silver exports entirely, not just tightening licenses, a full ban. India raises import tariffs to protect domestic supply. Russia announces a silver stockpiling program. The U.S. move sparks a wave of resource nationalism. By New Year, silver trades at $120 in Asia, $90 in Europe, and $60 on the zombie COMEX. The dollar loses credibility as the pricing mechanism for commodities. This is the moderate escalation scenario. Scenario 3: the full intervention. The CFTC announces restrictions Thursday. Silver crashes on COMEX. Then over the weekend, December 21st to 22nd, the Treasury Department announces silver is being classified as a strategic material under the Defense Production Act. Emergency powers get invoked. All U.S. Silver production becomes subject to allocation. Civilian purchases above 100 ounces require government approval. This is the confiscation setup, building the legal framework to seize private holdings. It's the nightmare scenario, and after the 1933 gold confiscation, it isn't unthinkable. Now I want to address the psychological warfare they're about to unleash, because the rule changes are only the first move. The second move is the media campaign. Starting Thursday afternoon after the announcement, you'll see a coordinated messaging blitz. CNBC, Bloomberg, The Wall Street Journal, they'll all push the same narrative. Regulators step in to protect retail investors from a silver speculation bubble. They'll say CFTC action prevents a repeat of 2021 meme stock mania. Silver speculators face restrictions as prices prove unsustainable. They'll bring on economists who insist silver fundamentals don't justify 60. They'll show charts comparing silver to past bubbles, tulip mania, .com, GameStop, and they'll parade out experts claiming the rally was driven by conspiracy theorists and Reddit manipulation. They'll paint anyone who bought silver as a reckless gambler. They'll present the CFTC as the responsible adult in the room. This is gaslighting at a national scale. They need you to believe you were wrong. They need you to believe the shortage isn't real. They need you to believe the government saved you from yourself. Why? Because if you buy that story, you'll sell. You'll hand over your metal at suppressed prices. You'll give them the physical silver they're desperate to get their hands on. Don't fall for it. When the media blitz hits, remember this: they don't run coordinated national campaigns to stop bubbles. Bubbles pop on their own. They run coordinated campaigns to smother truth. The fact that they're deploying every weapon, regulatory, legal, and media tells you everything you need to know. They're scared. You're winning. They're just trying to convince you that you're losing. Let me show you the historical pattern of government interventions backfiring, because this never ends the way they expect. 1971. Nixon closes the gold window and promises a strong dollar. Gold is $35 and it runs to $850 by 1980. 1933. Roosevelt confiscates gold in the name of national security. Gold is $20.67, then revalued to $35 the next year. The government pockets the difference, and citizens who held get robbed. 1980 liquidation-only rules hit silver. Price collapses from $50 to $10. But by 2011, silver is back at $49, proof the suppression was temporary. 2008, the SEC bans short selling of financial stocks, claiming it will stabilize markets. The market still crashes. Lehman still fails. The ban arguably worsens things by choking liquidity. 2020, Robinhood shuts off the buy button on GameStop for customer protection. GameStop falls from $400 to $40, then climbs back toward $200 within months. The intervention delays the move, it doesn't erase it. Every time the government steps in to save markets, they're really saving politically connected banks. And every time the intervention fails, it may postpone the reckoning. It may cause short-term pain, but it doesn't change the underlying reality. And here, the underlying reality is a physical silver shortage. You can't regulate away geology. You can't ban supply and demand. You can manipulate paper prices and force futures liquidation. But you can't make industrial users stop needing silver. You can't make solar panels work without silver paste. You can't make smartphones without silver. You can't print silver. That's why the CFTC emergency meeting is an admission of defeat, dressed up as regulation. Here's what I'm watching in the next 72 hours to confirm the thesis. Signal 1 over the weekend: watch for unofficial leaks. CFTC commissioners or staff could leak details to the press. If you see articles on Saturday or Sunday citing sources, that's your confirmation. Signal 2 on Monday and Tuesday: watch for CME Group announcements. They'll likely hike margins preemptively ahead of the CFTC meeting. If you see margin increases Monday night or Tuesday night, that's the runway being cleared. Signal 3. Watch for bank analysts turning bearish on silver. JP Morgan Goldman expect research notes arguing silver fundamentals don't justify current prices. That's them laying the narrative foundation for the drop. Signal 4 tracks Shanghai and London premiums. If the Shanghai premium over COMEX widens from $8 to $15, maybe toward $20 over the weekend, that's Asian buyers front-running restrictions. They're buying before the U.S. market gets locked down. And Signal 5, watch physical dealer premiums. If you see premiums jump from $12 to $18 or $20 on Sunday or Monday, dealers are pricing in the chaos. They're raising prices because they expect a surge in demand ahead of restrictions. Put all 5 signals together and you'll know whether this thesis is holding. And I'll be tracking all of it. One more thing I need to explain: why now? Why is the CFTC acting at this moment? Because of the options expiration on Friday. Let me connect the dots. Friday, December 20th, 4:00 call options at $70 expire. If silver is above $70 at 4:00 p.m., those calls finish in the money. Market makers would have to deliver 200 million ounces. They don't have it. So the banks call the CFTC and say, you have to do something, we're facing a delivery crisis on Friday. And the CFTC says fine. We announce restrictions Thursday morning. The price breaks Thursday afternoon. By Friday, silver is below $70, the calls expire worthless, and you're saved. That's the plan. The timing of the CFTC meeting 2 days before options expiration isn't coincidence. It's coordination. Regulatory capture is complete. The CFTC has become the enforcement arm of JP Morgan. They're not regulating the market, they're rigging it. And they're doing it in plain sight because they think you're too stupid to notice. Prove them wrong. Here's my final guidance for the next 72 hours. If you have cash and you want silver exposure, buy physical this weekend. Anything you can get, coins, bars, rounds, buy from local dealers to avoid shipping delays. If your local dealers are sold out, try online but place orders by Monday at the latest. Because by Tuesday, inventory could be gone or premiums could be double. If you own paper, silver, SLV futures options, make your decision by Wednesday. Either you accept the risk of restrictions and force liquidation, or you exit and rotate into physical or foreign markets. There's no safe middle ground. If you own physical silver, you hold. You ignore the price action, you ignore the media. You ignore the CFTC because what's about to happen is the system admitting you were right. They're changing the rules because the game was rigged and you figured it out. This isn't the moment to sell. This is the moment to hold tighter. And if you're in silver miners, understand this. Restrictions on COMEX don't shut down miners. Miners produce physical metal. If the great decoupling happens, if physical trades at $80 while COMEX is stuck at $50, miners get paid $80. Their earnings surge. Miners may be the cleanest way to play this if you can't get physical. And if you're on the sidelines watching take the lesson when the government intervenes to save a market, it means the market was breaking. They don't rescue things that are working. They rescue things that are failing. And right now, the paper market is failing. COMEX is failing. The bank's manipulation scheme is failing. And the CFTC emergency meeting is the white flag. December 19th, 2025, 9:09 a.m. Eastern Time, the CFTC convenes. By noon, the rules change. By the close, the paper market breaks. But the physical market will do what it always does when governments try to outlaw supply and demand. It routes around the system. It goes underground, it goes offshore. It flows to whoever has the metal and whoever needs the metal. Price discovery shifts from New York to Shanghai. It shifts from COMEX to back alleys, from regulated exchanges to private transactions. This isn't the end of the silver story. It's the beginning of the end of the paper story. The physical market takes over. And in the physical market, there are no CFTC emergency meetings and no liquidation-only rules. There's only metal or no metal supply or shortage. And right now, the shortage is winning. You have 72 hours. Use them wisely. This is the last warning. After Thursday, the game changes. Make sure you're positioned on the right side of history. Hold your silver and ignore the noise. Watch as the empire strikes back and misses. Because you can't kill a bull market with a press release. You can't ban mathematics. And you can't regulate away reality. The CFTC is about to learn that lesson the hard way. Enjoy the show. This is the greatest transfer of wealth in modern history, and you're watching it happen in real time. Subscribe,